Another panel here is on concentration, excessive concentration in Magnificent Seven. It's easy for us to sit and say, oh, how magnificent they are, but I know fund advisors are very worried about concentration risk. You, of course, have the QQQs, the Nasdaq 100, raking in money, doing great, or somewhat a subset of Magnificent Seven in a certain sense. But can you, it seems to be very rational for fund advisors, RIAs, to be concerned about excessive concentration risk, even as we watch these stocks go up and up.
Yeah, absolutely. I mean, I think obviously the beauty and benefit of the ETF is just providing, a lot of times a diversified access to a wide swath of stocks or, securities. QQQ being a great example, giving you full access to the Nasdaq 100. Of course, as you said, the Magnificent Seven stocks have been a great kind of component of that outperformance recently. Roundhill's ETF has certainly, been a big contributor to that. But yeah, in general, I think us at the exchange, we like to work with a wide variety of issuers and just helping bring access to kind of all these different types of portfolios, whether indexed or active, to investors.
I want to give the viewers a sense of how concentrated things are right now, and I want to thank Dimensional for providing me with this piece of data. So right now, there's an index, the MSCI All Country World Index. This is a basket of all the big stocks in the whole world, everything, including U.S., everything here. Right now, the Magnificent Seven is 17% of the value of that entire index. The U.S. is the largest single value. It's almost 50% of the market cap weighting. But the second group, Japan, UK, France, Canada, and China, are those 5 countries are the second through the 6th biggest group. They together are 17%. So this is a idea of how to get your head around how big these companies have become. 7 companies are 17% of the market cap of the whole world, and that's as big as the second to the 6th biggest countries put together at this point.
This is incredible, too. When you think about the fact that Microsoft is bigger than the entire market capitalization of the United Kingdom, if you're worried about concentration risk, that should be a big red flag for you. So it's a great time to be able to move away from some of those larger, growthier names into other parts of the market that tend to have delivered higher returns over time, like small caps.
So how do you do that? So the way I see the panels, Tony, is they try to nudge people, saying, well, look at quality, for example. Here's a great word everybody loves to use. QUAL is one of the big ones. Or momentum, and these tend to get subsumed in that to a certain extent. Is that a more rational way? I'm trying to figure out how people can address this genuine concern about concentration risk. I think it's very real, but you don't want people don't want to say, okay, how do I stay in without getting too in? They want both things here.
Well, you said at the outset, the U.S. ETF market just hit $8 trillion, right? It's accelerated. You've been a big part of this growth over the years. Recognize active ETFs until 2019 was less than 5% of the market. The regulatory change at the SEC allowing for active managers like Morgan Stanley and other great firms to enter the market with active management really enables that you can manage around the concentration risk. So again, before 2019, 95% of the U.S. market was passive. That's changing. And then I would say one thing, this is about choice. It's not an either or. Most advisors, Bob, and you know this, they use passive and active. Most institutional clients that we deal with, they use both. So I think the active element will help manage around some of the concentration risk.
And the vast majority of active ETFs we're seeing come to market are fully transparent, right? So it does come back to knowing what you own, for clients and within their portfolios, and having the ability to see on a daily basis what is being held in your active ETF portfolio that's, being managed by these institutional level managers.
Yeah, but active management in the traditional way does involve some degree of market timing. I've had many discussions with Dimensional over the years about the risks of market timing, and you can see this in the performance of Tesla, which is one of the 7 Magnificent Seven stocks. Tesla returned over 100% in 2023, and it's down 40%.
In the last 2 years,
In the last 2 years, if you look at it. So, I mean, that's about as volatile as you're going to get.
And
what does that tell you about the risk of market timing? That people are pulling their hair out about market timing on Tesla.
I mean, that's got to be incredibly frustrating for a traditional stock-picking active manager, which is one of the reasons why you've seen the growth in more systematic active management, where you're targeting premiums through better diversification strategies. I mean, if you got left out, if you were left behind at the market returns that you saw in last year, that's incredibly painful. These stocks should be part of your portfolio, but trying to jump in and out over the last couple of years, that's going to be a painful experience. That's one of the reasons we always advocate you need to work with an advisor, right? An advisor is one of the important people in your life who helps keep you on track and stay above all this intraday noise that you see.